All right, we got a new one for you today. Hope you're excited about this because it's been on the minds of a lot of investors right now. Snowflake just reported earnings. Obviously, this is what we typically call these people who are always getting butthurt, always have their feelings hurt. Snowflake, you know what I mean? That's not funny. But, so, Snowflake reported earnings down 3% after hours. New one for us, down 4% of the normal trading session. So it's worth taking a look at. Obviously, a company, certain Mr. Warren Buffett has his associates sinking money into. Let's look at these earnings, why don't we? So Snowflake posts a GAAP EPS of a negative $1.01, misses by 64 cents. Not your lovely, lovely stuff. It's an awful miss in terms of profitability. It's a really awful miss. So you do need to consider that. One thing you know is, Warren Buffett typically isn't investing in unprofitable companies, so one thing to consider, obviously, it's his associates that are doing it. Warren Buffett's too old to be doing this stuff, okay? He's not researching companies. He doesn't have the time, okay? But, it's an odd thing. It's a really big oddball for a lot of people because, again, this isn't the typical company that would be doing this kind of stuff, They're not typically invested by them. But revenue line, which is pretty important. You see 159.62 million, which is up 118% year over year. Really good growth in that aspect. Doubling revenues is really good. And it beats by 11.97 million, so a good beat there too, actually. Product sales were for quarter four. They're seeing product sales in the range of 162 to 167, which will be a good increase, obviously year over year, and quarter over quarter you see an increase as well. They did a presentation for me, which is obviously pretty big because we want to look at this company, right? Snowflake obviously focused on cloud data. Really big stuff here. So their cloud storage, this is pretty much their argument of what their how beneficial their cloud services are for everything from optimization and management to transactions, security and governance, metadata, sharing and collaboration. Their platform is one of the most beneficial, is what they are pretty well saying. Their platform from data engineering to data lake, data warehouse, data science, data applications, data sharing. Oh yeah, really good stuff. Really good stuff there. Top tier stuff. Obviously, growing market opportunity. Right now, the data warehouse, $14 billion there. Compared to the cloud data platform of around $81 billion. And the data cloud as a whole, just massive, massive potential there. They're expanding ecosystem here. It depends. Obviously, they have different segments that they're going into. From a build perspective on their platform, you see companies like SendGrid, Instacart, Localistics, and Lime. From the data perspective, people using their data from a cloud basis. Salesforce, which we just talked about yesterday, Adobe, FactSet, Braze, S&P Global, Experian, Heap. Services, you see a lot of companies on there. Technology, a lot of companies there. So again, there's a lot of companies using this platform, and that's, I think a big reason why a lot of people are pretty interested about the stock. There's backing behind it. There's a lot of companies interested in it. So again, product revenue growth year over year was 115%, 150%. Really good stuff. Net revenue retention is up 162%, which is obviously pretty darn important there. To have your customers continuing strong, large customer momentum. 65 customers that are $1 million plus in product revenue, and you want to see that number growing as well. Product gross margin at 70% as well is pretty darn good. Really good stuff. So, obviously they're saying they're not a service as a solution model. And 93% of revenue is consumption based, so this is due to transactions, obviously. So it's not just from a service, it's at the time where it's needed. That's what they're talking about here. Revenue is recognized variably only as consumption occurs. Rollover and unused capacity is permitted. Contract durations increasing along with the larger customer commitments. And primarily billed annually in advance with some on-demand services, and annually, obviously. They're not saying it's a service, okay? Even though it's kind of servicey of me. And they're seeing a shift of quarterly to quarterly in advance and monthly in areas billing the largest enterprises. But again, this is based off of really what's used, and that's their main point of it. It's based off consumption rather than just a set service. That's their main point of that. They're focused on remaining performance obligations and product revenue, obviously. Not a shocker there. Scale and growth, massive is what they're going to mention here. 174% growth in annual revenues year over year. Really good stuff. You're comparing the years. And quarterly up 119%. And you see a consistent growth in quarterly revenue as well. Remaining performance obligations really big as well. 240% year-over-year growth is really good too, because you see, obviously, remaining performance obligations is more customers. That's really what they're talking about, more customers being involved in this. And large customer momentum is increasing as well. Total customers up 84%, and large customers up 110%, but you want to see this number keep going up. Obviously, large customers are a big portion of it because you're talking about over $1 million spent just with one customer. It's pretty big to have a lot of customers like that. And then just obviously, total customers in general. Yeah, it's good to have quantity, obviously. And Fortune 500 customers, 500 best companies in the world, obviously. The largest companies. 56% growth there at 165 now. So yeah, it's really good to see those kind of numbers, but you want to see it continue to increase, and you need to see a good trend. And I think so far the trend's pretty good. You don't see a slowing down necessarily, so that is really good. Retention rate, obviously. Pretty massive stuff, pretty consistent here. Product margin, they talk about growth in that aspect. Free cash flow is increasing quite a bit. They're saying year-to-date free cash flow has increased definitely a good bit. Operating expenses as a percentage of revenue is decreasing. Pretty good. You want to see obviously less expenses than revenue, no doubt. And they're increasing headcount to take advantage of the situation. And again, companies hiring, it's usually a good sign that, they're growing, so they have to hire to accommodate that growth. So you need to mention that. Revenues by segment, obviously a vast majority is taken up by the Americas. Smaller segment by Europe, Middle East, and Africa. And then Asia Pacific and Australia. And China, don't forget China, makes up only around 3%. So really mostly U.S. based in this. Not a shocker, and they'll probably stay that way for quite a while. From a guidance perspective, for the full year, they're expecting 121% growth in terms of product revenue. Non-GAAP gross profit at 68%. Operating loss, not beautiful, but you see improvement. You see improvement. I can't lie. The appendix, nothing super exciting there. We will obviously scroll down and get to this balance sheet because it's a company I never looked at, so balance sheet it means a lot to me. It means a lot to me. They're giving me a 9 months comparison. Total current assets right now are sitting at 4.9, really right around 5 billion. That compares to 600 million only of 9 months ago. So they've really bolstered this cash position, cash and cash equivalents. It's gone up quite a bit, and short-term investments has as well. Total assets in general is at 5.7 billion, compares to 1 billion from 9 months ago. So honestly, overall, really good improvement in terms of that. And most of that's from the short term, but we also see long-term investments in here as well. Total current liability sitting at 547 compared to 416. Not that much growth in terms of liabilities compared to your assets. And I think that's really darn good, and you don't see much of a difference here. Total stockholder equity is at right around $5 billion. I mean, that's really good. It's really good. That compares to a deficit of $544 million of 9 months ago. So that's just 9 months, and that improvement's happened. I think that's really good, and it's a really good looking balance sheet for this company that's growing at a good pace. Now, one thing you obviously need to mention here, obviously a company that is recent IPO, not much movement necessarily since IPO, only really up 15%. You don't count this $3. That is not the proper opening for this stock. It was actually closer to $250, so not much movement here. Sitting at a little under 300 now, at 283 after today's losses. I don't know if I necessarily like the company, mostly because it's trading at a market cap of $81 billion with an annualized revenue less than $500 million. I can't justify that in my perspective. That valuation seems incredibly inflated. Incredibly inflated. Now, hear me out. Incredibly inflated. So, that's my perspective on the matter. I hope you like this and have a good one.